It's about 375 and it went up to 425. Okay. So 375. And these guys had a financial duration of 13.93 years. That means a small change in value or 1 basis points change in the asset yield is going to, or 1 basis points increase in bond yields is going to decrease the value of the bond in percentage terms by about 14 basis points or 0.14%. That's for 1 basis point. You can kind of speculate, multiply that by 50. That's about 7%, okay, for a 50 basis points increase. If it was a 30-year bond, it would be about 9%. Actually, let's do 30-year. Yeah. 1785. Come on. They told me you won't be in class today. Apparently, they don't know. About 18 years. Okay. That means if you lost 1.8 billion over a sale of 22 billion, roughly, you would have realized a loss as a result of sorry, not 100 basis points move in T-bond yields. I mean, I don't know when they bought it, so we're kind of speculating. If it was 20 years, it could have been even less. But that kind of move happened over a long time, okay? Think about that. I mean, maybe they bought it here. I don't know. When 20 years, let's look at the 30 years one. It's down to 346 now, but it was much higher earlier on. As high as 436. In fact, right before it went down on February 2nd, I think, or 3rd, or March 2nd or 4th. It was 4%, it's 364 now. Even as of here, the yields were 345. So if I'm a regulator and I'm in residence, I see these guys' portfolio every single day. Okay? Just let's think about how much mark-to-market loss they would have had from December 22 to January 23 in 1 month. Okay, it's 364 here, right? No, 341. Let's kind of look at it. Let's see. Why is this thing not? It should be worth 1,000. Apparently, this makes a mistake somewhere, but we're not going to worry about it. So let's get the old price. Copy. And in 1 month, it went to 398. Okay. Oops. Let's keep that 398. So bonds lost about 10% of their value. Okay. Just in that 1 month. So I'm a regulator sitting in a residence, and they have to open up by law if you're, considered a bank that's important for the system, which is now 250 billion or more. But had Dodd-Frank not changed, it would have been 100 billion or more. I would see from December to January that these guys need a capital infusion of $2 billion. Done. Either A, you let them get the capital, B, you take them down then. Okay? One of those. But now we don't have that capability. We can only do it from quarter to quarter. And second issue is this is not just a regulatory issue. Is that the bank took too much interest rate risk with their liquid assets. I mean, there is nothing wrong wanting to invest your assets into something that yields high return, obviously. But you also know that a big portion of your, I think close to 90% of their deposits were uninsured deposits. If there is indeed a bank run and those guys took their money out, you don't have enough liquid assets, to take care of that. In this case, roughly 10% of their assets were taken out, and they had to sell their liquid assets to take care of that. Well, then, they were not marked to market. So as a result, you needed capital infusion, and you couldn't get it. What do you think they could have done that would have prevented this issue? Is there something they could have done? If I asked this question 40 years ago, the answer was not too much unless they put everything into 3-month T-bills, where a change in interest rate doesn't change the value of the bond by much. But now we have all sorts of instruments available. You have, Eurodollar futures as short-term rates increase. It actually gives you, If you go short on those futures, you make money on the futures, you lose money on the T-bond, but they cancel each other out. We have swap contracts that are much better suited to handle. Uh, there's nothing wrong with taking a position on the yield curve, going long the long end, maybe short on the short end, but you got to limit the risk. You have to look at what we call in risk management value at risk. What would happen if something that would only happen with a probability of, let's say, 1% or less? If that happened, how much money would I lose? That's an example of value at risk. And then you should have enough really liquid assets that's going to take care of that. If you don't, you're going to have to hedge that risk. They didn't hedge it. If they hedged it, they wouldn't have lost that much money. This means they chose. This is a decision. They didn't. It's not like they didn't know. They chose not to hedge this risk, and it was too much. And here is how I know. Let's look at something. SEC filings. Actually, let's go to sec.gov and let's look at the filings. We normally look only 10Ks and stuff, but there are other filings, okay? Let's look at March 1, okay? Basically, 2 days before the bank was taken down. In this case, let's see who this guy is, Daniel Beck. He sold, I think S means sold, or D means discount, I'm sorry. He sold 2,000 shares on 227, okay? Just 1 week before all this happened at 287.59. That's over that's over $500,000. But this guy, I don't know, is CFO, okay? Let's look at another one. This is Groger Becker. He's the president and CEO. He exercised his stock options for over 12,000 shares, okay, at 105 and sold them over at 205. 12,000 times about 180.